Moving countries can be one of the most exciting and most challenging things you'll ever do. And we're here to take one big worry off your plate: your taxes. At Expat Taxes, we understand the complexities of Irish tax from your perspective as an expat and tailor our advice to your needs. With decades of expertise, our team at Expat Taxes will help you navigate tax residency, cross-border taxation, reliefs and returns, and will work with your country's tax advisor to make sure your taxes are sorted. Whether you're an individual or a corporation coming from Australia, the United States, the UK, or anywhere in the world, we want to help you. So visit us at expattaxes.ie to book a consultation today, and let's make moving to Ireland easier together.
Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Hi, my name is Stephanie Wickham from expattaxes.ie. You're listening to the Tax Bites for Expats podcast, the show that explains the do's and don'ts of income taxes for people who are moving to or from Ireland.
So welcome everyone today. On this episode we are going to be speaking with Sam Ashley of Faber Tax from the US. And Faber Tax is a boutique tax practice that focuses on providing US tax advice and support to US expats who are all over the world, really. Great to have you on, Sam. Thank you so much for joining us today. So before we kick off, I thought maybe if you could tell us a little bit about yourself, maybe how you got into tax and I suppose specifically US taxes.
Yeah. So from the accent, you'll probably tell that I'm not American, and actually spent very little time in the States. So my journey into US tax was after university. I joined Ernst & Young and joined their sort of expat tax teams and specifically focused on that US side in the team that I was in. And I've sort of continued in that focus for the remainder of my career, really. And throughout the years I've been involved in US tax, I've gone from Ernst & Young. I then moved to KPMG, actually over in Zurich in Switzerland. And that's where I met Ian. So that was probably best part of 20 years ago now. So we shared a small and very hot office in Zurich for a year or so, and stayed in touch ever since. And then I came back to the UK, spent some more time with Ernst & Young and a couple of boutique firms, and then just over 18 months ago now, I was having a chat with Ian. He needed some support with his business, and we decided to sort of come together and sort of expand his offering outside of the US, and so I'm now obviously in the UK working with Ian.
It's brilliant. And I think the really good thing about your story there, so obviously, Faber Tax is headed up by Ian Faber, who's in the US. You're in the UK. You've both lived in Switzerland. And that's one thing that kind of comes up time and again, is that when we're providing this type of advice, when we personally have an experience of being an expat and living overseas, it gives a little bit of a slant to the advice. I mean, in my mind, because it is such a stressful thing trying to plan taxes cross-border, if you're working with a team who have a bit of an idea as to how difficult it can be to navigate these things, it brings a bit of a different aspect to it, doesn't it? Just understanding the logistics.
Yeah, absolutely. I obviously moved across to Switzerland. You're in a tax system which you've got no idea about. There's all sorts of things going on where you needed to register for certain things, and being an expat, that's all can be very stressful. And then you add on, well, I've got to do a tax return, for Americans, you've still got to do a tax return in the US, and then you also have to do a tax return in Ireland or Switzerland or the UK or wherever it may be, and suddenly it can feel very overwhelming. And I think having an understanding and having been an expat myself, I think you really start to understand that, if you can talk in a way which makes it less complicated and less scary, I think that really helps people. And if you're and what we focus on with Faber Tax is trying to take that stress off them and say, okay, we've got this, we need your help with it, but we'll handle it for you.
Yeah, no, I think it's brilliant. The way you guys work is really impressive. So I suppose today, I mean, there's so much we could talk about, but, you know, we only have a certain amount of time and it's a heavy topic. So I think the aim is to really kind of, you know, boil it down to a couple of key issues that if a US citizen is planning a move abroad or perhaps is living abroad, what would be the main issues that you see coming up? Particularly if someone's leaving the US and, you know, they're planning that move overseas. You know, even from my own perspective, it's commonly known that, you know, Uncle Sam keeps his hand in your pocket long after you've left the US. But how does that play itself out? What are the things you think people need to be aware of?
Yeah, so the first thing to think about with US tax is it is a tax system that's based on you having citizenship in the US. It's not a case of you're resident there, therefore you're taxable. So it has this more sort of worldwide reach. You're taxable on your worldwide income. And that's probably the first point where it gets scary for people. It's like, well, if I'm taxable in the US and I'm also taxable in Ireland, you know, I'm going to end up paying huge amounts of tax. And this is probably somewhere where you need to start thinking about getting some advice before you move and talking to someone who understands that cross-border element. And so that's sort of the first step is to realise that you've got this worldwide tax system. And then the next is to say, okay, well, how does that work? How am I not going to be double taxed? And I think, you know, the things we look at to avoid a double taxation is, from a US perspective, you have an earnings exclusion, which allows you to exclude around $109,000 of income from taxation in the US, provided you meet certain tests. So that's the first step. So you know, you could move overseas, claim the exclusion, very easy. You're just filing in the US, there's zero tax due because you're excluding all your income.
And Sam, does that apply to all income or is it just specific types?
No, that exclusion is only for employment income. And it can be employment or self-employment, but it's only for sort of that sort of employment type of income. So we're not talking about bank interest or investment income or rental income, those sorts of things. We're very much talking about just the main source of your income, if you like.
Okay.
And so you meet these tests, one of which says you have to be physically present in a foreign country for 330 out of 365 days to qualify. So if you arrive in, say, I don't know, what is it? It's August now, isn't it? If you arrive at the start of August, you're looking at qualifying for that test the August of the following year. So once you've done your day counts, and we can come on to extensions and things like that you get when you're overseas in a second. And the second one is that you need to be a resident of a foreign country for a complete US tax year. And so again, if you arrived in August, that period for you would be from January of 2023 through to December of 2023. And again, there's extensions that we can get if you need that. So it's tricky, and I think, you know, as I said at the start, the first step is to talk to someone and say, okay, how do these tests work for me? You know, which test am I looking at based on your own fact pattern? Because we look at how much time are you going to spend back in the US.
Yeah, and this comes up time and time again, isn't it? Really, that, and I think you probably see it. I see it is that sometimes when you approach your local accountant or your tax advisor who supported you before you've left, they can kind of panic a little bit and think, well, I've never done this before, and they're actually probably perfectly capable of dealing with it. But there can be an element of ease, I suppose, of transitioning to an advisor who does just work in that space and is just able to kind of recite the requirements verbatim because they do it day in and day out. And is there anything you would suggest people do, you know, I suppose, to avail of that in advance of leaving, or is it more just about kind of being proactive in the first year that they're out of the country to kind of make sure they're going to meet the conditions for these exclusions?
I think it's important on a couple of levels to have the conversation up front. One is the exclusions. The second is you've got to remember in the US, you have federal tax, you also have state taxation. So we need to consider, okay, well, what's your ties to that state? Are you going to remain a resident of that state despite living in Ireland because of the amount of time you spend back, or because you have available property there? So there's definitely a planning element both on that federal exclusion and also for state taxation.
And I would completely agree with that from an Irish perspective, because the concern we see is you don't get a credit for the state tax here. So it is actually just a leakage of cost. And is there things people can do, proactively? Like, obviously then they just can arrange their affairs to try and break that tie? Or is it basically state specific?
Yeah, every state has their own rules. But what we're really looking at is where are your family ties? Are you moving your family with you to Ireland? Are they remaining in the state? What's happening with your home? Is that going to be available for your use when you come back? And also, where are your driver's licenses? Where are you registered to vote? It can come down to very small things, and so it's important to look, for every state, wherever a taxpayer is from, and say, well, what are the rules to break residency? And how do you practically go about doing that? Because as you said, you can end up in a position where you're paying Irish tax plus whichever state tax you were based in prior to your move, and that's obviously going to get a bit expensive. Yeah,
totally, definitely, especially when you're moving to a location like Ireland where tax rates are so high for individuals. Definitely. Yeah. Okay, so that's, I suppose, income exclusions and being aware of tax credits, and this is something we've spoken about before, but I'm sure you time and time again get people who, they understand there's a double tax agreement. They know they're going to be taxed in the US after they leave, but the practicalities and how the actual treaty applies, in my mind, there's not much point in trying to actually go through each and every income type, because that is really the answer, isn't it? It's like, if you are going overseas and you're going to a location where there is a double tax agreement, you're going to have a level of protection. That's how it plays out from a US perspective as well, I'm assuming.
Yeah. So you need to look at different types of income. How is that going to be taxed in the country you're moving to, be it Ireland or wherever else? And then how do we then reflect that in the US tax return to ensure there's not a double taxation? And sort of as an addition to that, as you live in Ireland longer and you start thinking, well, I'll start investing locally. How are those investments taxed in the US? There's some complicated rules. I'm not going to suggest we go into them now, but there's some complicated rules with foreign investments which can lead to some quite penal taxation in the US. So just having an advisor who understands the implications of investments, and someone you can pick the phone up to and just say, I'm thinking about this, what do you think? And they can talk it through with you is ideal. Or always take some advice, because I know, obviously I'm based in the UK, we have investments here where people can walk into a bank, less so these days for your US citizen, but you used to be able to walk into a bank, open up an account and think, oh, that's nice and tax-free. And it's not tax-free in the US.
It's caveat emptor, isn't it? Just be careful when you're purchasing these products. So filing dates, how does it work then? If someone's they've taken the advice before they go, there's a bit of comfort there. They know they're not necessarily going to be in a double tax situation, with a couple of exclusions such as state tax with a bit of planning. What to do and when? What do they need to mark in their diary?
Okay, so for a US citizen, tax day is always April 15th. When you move overseas, you get an automatic extension through to June 15th. So you get an automatic 2-month extension. What we have to be cautious of there is the IRS is saying, yes, you can file 2 months later. That's not a problem. But if you owe tax, they're going to charge you interest on that balance due from April 15th. So again, this is where some pre-advice might help. If you've got investments in the US, which are producing income and tax, they may well have a tax liability attached to them, which needs to be paid by April 15th.
Right. Yeah.
And then once we reach April 15th, we can then apply for a further extension. We can get that extended through to October. And then if that's still not long enough, we can get through to December for a regular taxpayer. So, or you can get all the way through to December 15th, but you have to remember that interest and penalties will accrue from April 15th through to the date you file, unless you pay that tax.
So then you probably see people making kind of preemptive payments to kind of, settle your tax, make sure you're not going to be up for an interest or a penalty if it transpires. Yeah, okay. So there's definitely, it's the level of comfort, but it's not a it's not a silver bullet. Yeah, I understand. So that means you guys are busy all year round. That means you don't get a break.
So what we're looking at is, getting people to pay tax by April 15th, if there's liability due, and then saying, okay, well, what's going to happen in the coming year? Should you be making estimated payments in advance throughout the year to pay your 2022 liability ahead of the 2023 filing deadline, along those lines. And those payments can be made again April 15th, June 15th, September 15th, and then the following January 15th. And that again, if you're expecting a liability in the US, that's a good thing to do, because again avoids penalties for not paying those payments and further interest and things like that.
Okay, so be aware of your due dates. Don't assume that you have lots of time to settle tax. Beyond that April date, and be a bit proactive. So I suppose then further to kind of compliance obligations, FATCA and FBAR. Tell us a little bit about that. I mean, I'm not even going to pretend to be an expert on that, because these acronyms come up. I'm sure a US citizen moving abroad is just as terrified by them as as the rest of us are.
Yeah, and this probably goes back to the point of, you mentioned earlier about you've got your local accountant in the US and suddenly you move overseas. Unfortunately, moving overseas can bring a whole load of other filing requirements with it, and one of those is the FBAR, the FATCA filings. So the first one we look at is what we call the FBAR. That's required if you have, in aggregate, more than $10,000 in foreign financial accounts. And what we look at is the maximum balance in each account. So theoretically, you could have $2,000 and you could move that through 5 different accounts and you will have met that 10,000 threshold. So you've got to make sure you're looking what's the maximum balance, and making sure that form is filed each year. That's due at the same time as the tax return, April 15th, but it's for the past few years it's effectively been automatically extended till October, but it's an important one to get in. There's no tax on it. There's no, they're not going to tax the balances of your accounts. What they're going to do is what you need to report is where you hold the account, what's the account number, the address of the bank where you're holding it, and then what's the maximum balance, and that's it. So it's quite a simple form.
And when you move overseas and you have 25,000 forms to complete as you apply for all the things in a new location, like, what's the so what? So what if I don't? So what if I didn't? If someone's missed that or they haven't picked it up, what's the concern there?
The concern would be whether the IRS see you as willfully non-filing that or non-willfully. So if they're going to say, okay, you knew about this account and you knew about this filing and you've purposefully not reported it, they can penalise you up to half the value of the account per year that you've not reported it. So in some circumstances, you can end up with a penalty which is more than you actually have in the account. Okay?
Yeah.
If you've just gone, hands up, I've forgotten it, then they can still penalise you, but they'll limit that to about $10,000, which is not a small amount of money. So. Still
not a small penalty. Yeah. Okay, so get that right. And, practically speaking, clients always say to me, so what are the chances of that happening? Do the IRS police that actively? Do you see that being an issue, given that the majority of people, or I imagine some people, genuinely don't know they have to do it, or maybe behind, particularly for the first couple of years that they're overseas?
Yeah, in practice, I personally have not seen penalties assessed on my clients. And yes, we do have clients who file these things late, and there are procedures that you can go through. So if you've moved overseas several years ago and never filed a tax return, there are procedures we can use to get you back in the system. But there are court cases out there worth several $1 million of penalties are being charged.
Yeah, scary. FATCA.
Mm-hmm.
Tell us about that.
Well, yeah, the FBAR is all part of FATCA, and then where we then extend into the tax returns, there's an additional form within the tax return whereby you report almost the same information, but it goes to the IRS rather than the US Treasury. But the threshold for that is considerably higher. It's depends on your filing status, but if we say it's sort of around $300,000 if you're living overseas. So if the balances of your foreign accounts are over sort of $300,000, then you probably need to add this form 8938 to your tax return and report that as well. And it's important to do because if you don't file it and you had to, then you haven't filed a complete tax return. So therefore the US statute of limitations, which says we can't look into you after 3 years, doesn't apply. So the IRS can go back to that return at any time. And the second thing to remember there is if an expat moves back to the US, those thresholds drop quite considerably. So they drop to about $50,000. So you've got to make sure you're on top of those those sort of additional findings, because there's some stuff in there which can make life very difficult.
Yeah, definitely. And the reality is that when you're trying to do your tax return, you don't really want to have to worry about these things, do you? You just want it done. And so often people say to me, I just want to know it's right. I just want to know that there's no issues there. And, we kind of keep coming back to this point of just get somebody to do it for you who knows what they're doing. Mm-hmm. Pay the money, move on, and just rest assured that you've got nothing lurking, that you're unaware of. It's just so clear that there's such value in that. Okay, so I mean, the points that are coming out to me, and please add to them if I've kind of missed them or, not summarised them correctly, would be don't miss your foreign earned income exclusion and criteria to meet that, and, be aware you're going to get some level of protection from a double tax agreement, but obviously focus a little bit on the state tax position warrants a bit of consideration, given that usually there isn't credit for that, or I mean, definitely from an Irish perspective, there isn't. Be conscious of your filing date extensions, that they're there, but again, there's limited benefit to them if you haven't been proactive. And then obviously just being cognizant of the fact that your filing obligations have changed, particularly from an FBAR perspective. Once you've gone overseas, it's something you need to be aware of, and you will or could potentially be very heavily penalised for not complying with that. Great tips. I mean, is there anything else we've missed? Things you'd say to somebody if they were getting on the plane tomorrow, or do you think that's kind of hit the nail on the head?
I think those are great points, and I guess that it just goes right back to the start where we say just talk to someone, preferably before you move. But if you've already moved and you're hearing this, then reach out and have a chat and just make sure everything's in the right place, and you know what your what the system allows you to do. And how to make sure you're staying compliant in the US, because no one wants to be living overseas and receiving nasty letters from the IRS.
Yeah, definitely. So where's your most interesting client been, Sam? I mean, I've got some people in far-flung places. I spoke to somebody who was in Kiribati, which is a little island in the middle of the Pacific Ocean, and I'm going to be completely honest, I had to Google it because I had no idea where it was. But where's your most interesting client been?
Oh, I don't know. Sort of
put you on the spot now.
Location-wise, I don't know where the most interesting one's been, but we've definitely had interesting clients. We've had actors that have appeared in some quite big films and sitcoms that I've watched and things like that. I always find it surprising that the people that ring you up just out of the blue and you're like, oh wow.
Yeah, totally.
It's amazing. But we had some lovely clients.
Yeah, it's great, isn't it? I mean, everyone's story is interesting, and the bit I love is kind of the, this is my tax position and this is the reason for the move, or this is the reason for the question. And the thing that comes through to me time and time again is, people want to get it done, they don't want to worry about it, and then just get on with the business that they're in, whether it be moving because they are an actor, or moving a family, back to Ireland from the US, or there's just so many different stories and they're all really interesting. But hopefully none of them have a bad tax ending, and these tips have been fantastic. Thank you so much, because your time is valuable and we really appreciate you taking the time to have a chat with us. And of course, if anyone has any tax questions, US related, either Sam, who's in the UK, or Ian, who's based in the US, would be delighted to assist. And yeah, we'll have to do this again. I think we've still got lots to talk about.
There's lots to talk about, and it always changes a little bit as well. So we'll have to do it again. And thank you very much for making the time and inviting me on this podcast.
I really enjoyed it. Thanks so much, Sam.
Thank you.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.